Let's Talk Money.
Hello and welcome to Let's Talk Money, your weekly personal finance date with me, Surabhi Upadhyay. Well, buying your dream home is perhaps one of the biggest decisions that you take with respect to managing your money and your finances. Now, whether it's buying a house or it's selling a house or it's investing in a house property, these are all big decisions, and they require careful tax planning and tax considerations as well. And that's exactly what we're going to focus on the show today. I have with me someone who's a big expert in these matters when it comes to property and taxation. Roongta, founder of Fee Only Investment Advisors, is here with me in the studios to throw some light on this rather complex subject. So, Harsh, thank you so much for joining in. And, I'm already bracing myself for all the different tax sections that we have to be aware of: selling, buying, renting a property. But the floor is open. So you start with what is the thought process with which we should approach property, whether it's for self-use or for investment.
So I think one thing is that there is far too much emphasis given to tax while looking at a property purchase or a sale. It is like any other asset buy or a sell. Tax is a consequence. You first do a calculation whether it makes sense to buy a property or it makes sense to sell a property. Okay. All that tax does typically on selling is that it will reduce the value of what you sell. It will effectively reduce your selling price, and maybe you can do something to sort of not have that reduction. Whether it is worthwhile or not, you've got to figure out. But the short point is, I think too much emphasis on tax or doing a purchase or a sale based on tax, I think is unwarranted.
Fair enough, but I suppose, once your other larger sort of issues have been sorted as to why you're doing a sale or purchase, that's when it's important to do your tax math, right? To make sure that you've completely covered yourself over there. So, Mr. Roongta, we want to take it step by step. We also have lots of your questions that have come in on this issue. Let's start by understanding the decision to purchase a house. Once that decision has been made and once you've figured out that yes, you're going to take a home loan or you have some capital set aside for it, or maybe you're going to sell other assets and then deploy that money to purchase a home, how should one go about the structuring, the whole sort of getting the financial math right as you're looking at this big ticket item?
So, like everything else, the decision to purchase precedes how you will finance. Now, the decision to purchase can be divided into two parts. First, you're buying something to stay in it. Second, you buying something to invest, and I think the considerations are completely different. When you are buying something to stay, what is really important is the locality,
Yes.
Affordability. Can you really afford?
Yeah.
Versus you may want to stay in a certain locality, but you may not be able to afford buying in that locality. So maybe you are better off renting in that locality.
Yeah.
So the buy versus rent, subject to a certain locality, right, is a very important decision when you are buying it for staying, right. Then comes, if affordability is there, that takes into account that you will have the money for the down payment, you will have the money for paying off the EMI, there will be income enough to pay the EMI if at all. You may also decide not to take a loan. Okay. So, my point is that is the consideration, where locality is the big consideration. Sure. Moment you are talking property, I think locality goes out of the window basically, except as one more parameter to see whether that will give a return kicker, etc. Another example of what may not be important is in an investment property. I can't understand why anybody would buy under construction, because that's a huge additional risk. You are not buying real estate, you are buying a builder's promise. Okay. Whereas when you are buying for home, you may decide to buy under construction simply because they give you the amenities that you are looking forward to in the locality in which you are. wanting to buy, there only under construction might be there.
Yeah.
So you may decide to take that risk.
Right.
So you see that the parameters are completely different.
Absolutely.
And you will also notice I never mentioned tax at all.
I realize that till now, yes. But having said that, now what we want to do is start by understanding some of the very basic fundamental concepts. If you are either looking at becoming a homeowner or are a homeowner, one is income from house property, this concept and how it's sort of, defined in tax parlance. And the other is this concept of loss from house property. A lot of people are thinking already about a loss from house property and how then they can be very smart with tax saving, etc. So let's again go back to the basics.
So like everything else in tax, it's complicated. So I will try and make it a little simple. First, it needs to be divided up between property where you stay yourself. When I say you, it can be you, family, anybody else, versus the properties that you have let out. For properties that you stay yourself, there is no question of a rent. Okay, you getting any rent. So therefore, you are allowed to minus from the, and that's always going to be a loss. So that's called self-occupied property.
Right.
From there, you are allowed to minus. You are allowed to claim a loss up to 2 lakh rupees in respect of interest paid on a loan taken to acquire that property.
So the reason it's called a loss from house property is because the annual value of that house, it's deemed to be, I think, 0, right, in this particular case.
Correct.
And then you are paying interest on that house, interest on the home loan,
Correct.
which you can claim as a deduction.
Correct.
So since you are paying an interest, you're paying off a loan, there will be a loss from that
There
particular
will be a loss
house property.
Subject to that 2 lakhs simply because that is the maximum that is allowed to be deducted. To complicate it further, that deduction is allowed only under the old regime. It's not
there
allowed
in the new regime. Important. Okay, so what all can you do with this loss? Now, I bought a home loan under the old tax regime. I'm, getting my 2 lakh rupees of deduction on the interest, 1.5 lakh rupees of deduction on the principal under Section 80C. Now, I have loss from this house property in which I'm staying. What can I do with the loss?
You can adjust it against your salary, you can adjust it against your business income, income from all other heads of income.
But up to what levels?
2 lakhs, maximum of 2 lakhs. In self-occupied property, the loss cannot be higher than 2 lakhs. Because the maximum allowed deduction itself is 2 lakhs. So the loss cannot be more than 2 lakhs.
Okay.
Now, so I'll come to the second leg.
Right.
In the second leg, where we are talking of let out properties, properties on which you're getting rent. There, of course, the rent is taxable. From the rent, you minus the municipal taxes paid for the property. Whatever is the resultant figure, that's called annual value. 30% of that is allowed as a standard deduction.
Right.
For all expenses incurred to manage the property, etc.
And this is a house that you've let out.
This is for a house that you have let
rental
out.
Income from that house.
Absolutely.
Okay.
Then you are allowed to claim without any limit any interest you might have paid on a loan taken to acquire such a property.
Okay.
And this is under both the new tax regime as well as the old tax regime.
Okay.
Now in India, what happens is the rental is roughly 2-3% of the value.
Correct.
So let's say 2% net of municipal taxes. If you have taken a 70-80% loan, on that if you are paying 8%, that's like 6.5%. So invariably this will result in a loss.
Even on a rental income, you will have a loss.
You will have a loss, at least till the loan is there.
Yeah.
Right?
Yeah.
Now that loss, again up to a max of 2 lakhs,
okay,
you are allowed to adjust it against salary, business income, etc. Balance loss, you can carry it forward.
For 8 years?
For 8 years.
For 8 years. Okay, Mr. Roongta, I want you to help us out with an example here in terms of capital gains that arise when you're selling a house, either a house that you stay in or a house that you've let out, and whether those capital gains should be reinvested in another property to save on paying that capital gains tax. So if you could give us an example.
So let me use this example to create a framework on how people should think about this, right? Let's say the property you sell at 1 crore, net of brokerage, everything. Let's say you had bought it at 30, but because of indexing, it becomes 70 lakhs.
Bought it many years ago, 30
many
lakhs.
years ago at 30
There's capital
lakhs.
appreciation, Indexing,
it
yeah.
becomes 70 lakhs
Yeah.
becomes the cost, indexed cost of acquisition. Now your net capital gains is 30 lakhs. It's more than 2 years that you have the property, therefore, this will be taxed at the normal long term capital gains tax, which is 20%.
Okay.
So, on 30 lakhs, the long term capital gains tax is say 6 lakhs. We will
Correct.
ignore surcharges
Sure,
and cess
sure,
for the
sure,
minute,
sure.
right. Now,
So I'm selling a property for 1 crore rupees. The tax I have to pay, capital gains tax, is 6 lakhs.
6
Okay.
lakhs, right. Now, the decision for you to take, obviously, whatever you do with the 70 lakhs is up to you to do. The choice is in 30 lakhs. For that 30 lakhs, you could either invest it in a capital gain bond, right, which allows complete exemption. That will pay 5.25 taxable interest. That is one option number one. You can buy a property of 30 lakhs, okay, and hold that property for 3 years, post which this will, so the capital gains is not payable. Or third option, which very few people consider, is pay the 6 lakhs and invest the 24 lakhs, because end of the day this is an investment decision, which is what I want to tell people.
So you say 24 lakhs because looking at the indexed cost of that house at 70, the gain is actually 30 lakhs.
Yes.
And out of that you can just pay 6 lakhs as tax and invest,
and invest the
rest.
balance 94 lakhs. Now, the issue is capital gain bond scheme is still okay, because you just pay 30, it's a financial asset, fine, there is no handling required, it gives you a certain yield. Net of tax, say the yield is 4, after 5.25, let us say 1.25% tax. So, let us say 4% net of tax yield. At the end of 5 years, you get back the money, and then you can do with it what you want. So, you are just taking the punishment of investing in a very safe instrument for 5 years. It is locked in for 5 years.
Correct.
The second instance of buying property, and I will tell you why that is not so great, I am not a great fan of that, is one, you will not get a property of 30 lakhs.
You will have to go to some tier 2, tier 3, tier 4.
Maybe, or you will buy a property which you, if you go, how will you manage that property?
And what is the appreciation? What is the rent you will get on it?
Correct. So, if you have to again invest back 50, 60, 70, 1 crore, or be involved with that property, give it out on rent, keep it locked, deal with the society. I mean, this is not something that people, so there is this blind thing is somehow I must not pay tax. All that I want to do using this show as a medium is please consider the third alternative, pay the 6 lakhs tax.
No, I think you've made a very strong case for it, and with that example, it's very, very clear as to why you perhaps are better off just paying that long-term capital gains tax and using the rest of the money much more judiciously, investing it in a wiser manner. Need to take a very quick break, but we have lots of viewer queries on the other side, so we'll quickly come back and start answering them.
Let's talk money.
Welcome back. You are with us on Let's Talk Money. We have, a viewer joining in now, and I must say that it is this viewer's queries and very, very specific, nuanced queries that actually led us to thinking about doing a whole show on it, and that's what Let's Talk Money is all about. You ask, and we decide to do this on the show and then answer your questions. So, Mr. Roopchand, congratulations first of being so meticulous with your queries and questions. I know you have several housing issues at hand, so let's straight away get to it. What's your first question?
Our society is going for redevelopment, and I was just wanting to little bit confused, as because there are some payments etc. involved by the builder, like they will give us rent, they will give us some allowances etc., shifting allowance, brokerage, and also some corpus. I mean, are these taxable? I understand they are not taxable since they are termed as hardship allowance, but I'm not very sure. Suppose you don't spend the rent or something like that.
Okay, great question. Just hang in there. I'm going to straight away toss this to Mr. Roongta. Lots of people probably sailing in that same boat where houses either going in for redevelopment or has gone in for redevelopment. So what all are we entitled to getting in terms of from the developer, and then what's the tax treatment?
So, if it is of any comfort to Mr. Roopchand, I am sailing in the same boat as
Oh,
what
really?
he is sailing into. Unfortunately, for Mr. Roopchand, there is no hard answer.
Oh, okay.
This is hardship compensation, redevelopment is not specifically covered in the Income Tax Act. So, you have to go by the normal capital gains tax provisions and what is considered capital, what is considered revenue. So far, the income tax department's ability to tax ultimately all the recipients for the hardship compensation has not succeeded.
Okay.
All the decisions are basically tribunal decisions though, but all decisions are in favor of the recipients,
Okay,
the
so-
taxpayers.
So
that
basically,
it is not taxable.
it's not taxable.
Correct. That it
Okay.
is a capital allowance, it is capital, it is not income, and capital is normally not chargeable to tax, capital receipts. Some capital receipts, because of what is provided in the Income Tax Act, gets taxed, not hardship compensation. That has been the ratio of the tribunal decisions. I am going to hasten to add that please do not take this as a conclusive.
It's a matter of, I think, debate and litigation perhaps.
Absolutely.
So you need to be
it
cautious.
will invariably go through litigation. Okay.
okay.
There is no certainty. The revenue refuses to agree, at least in the first instance. So, most likely you will succeed, but you will have to
Could be an
litigate.
arduous fight if you want to sort of,
It will have to be a fight. I would not use the word arduous, but it
Okay.
will be a fight.
Fair enough. So that's the first part of Mr. Roopchand's query on, whether the receipts coming in from a property developer, whether they're taxable or not in the case of a redevelopment. Mr. Roopchand, now I know that I think you're also planning to buy a second house. So tell us what's your question is with regard to that.
Because what happens, there's uncertainty of developers. Sometimes you hear stories that the building doesn't gets constructed for 10 years or something. Now suppose the builder stops rent after few years, then where are we are not anywhere. So we were think that instead of going for having a sword above our head, we should buy another house instead in the name of my son or my wife, or only my son. I'm not sure in whose name to buy the flat. That was the question. the Currently the flat which is going under redevelopment is in my name. I wanted to know whether my wife, who also doesn't have a house, my son also who doesn't have a house, whether they should buy one in their joint names together, because we are going to sell. We have sold some shares and there are some capital gains and all that are there. I understand in case they are invested in a house under section 54F, the full proceeds, if the amount, they qualify for some exemption. That means you don't have to pay capital gains on that.
Okay. Again, a set of questions in that one question. Should he buy that second house in wife and son? Should they buy it jointly? And what about using proceeds from sale of shares, let's say? I mean, how do you sort of plan for this?
I mean, these are overtly specific queries, which is very difficult to answer on a TV show. But let me give again principles. Okay. The principle is that subject to certain limits, if the capital gains that arise, assuming that the hardship compensation on redevelopment is treated as capital gains, let's assume that, okay, because nobody can prevent him from buying a house.
Correct.
Right.
Correct.
It's only, I think his queries are basically on tax.
Yeah.
Rather than on whether he should buy the second
Yeah,
house.
yeah,
So,
yeah.
obviously, if these hardship compensation is treated as capital gains, then he can buy a second property. Please remember, the old property is going to be exchanged with a new property.
Right.
I am presuming he is not selling the old
No,
property.
that's a redevelopment
That's
property
a
that he's holding on
redevelopment.
to.
So under section 54, that is the primary exemption that he is claiming. Now, of course, it is allowed that you can invest in two properties, provided that the capital gains does not exceed 2 crores. So, I have no idea what the figures in the case of Mr. Roopchand is, but if that is true, okay, then maybe he can buy that second property in his name. He has to be one of the joint owners, and that contribution to that much extent must come from him. If the shares etc. that he is selling are in his name, and in the same property he wants to take that 54F exemption, he can.
Okay.
He can do that. There is no bar, okay, on the same new property being used to claim multiple exemptions. as long as the amounts add up.
Got it. You know, speaking of shares, I think that's another query. Mr. Roopchand, very quickly, we are running short on time now. But just tell us more about the taxation issues that you have with respect to selling shares and then using those proceeds to invest in your new house.
Financial year we have sold, and now actually the subsequent question is also that means can for two consecutive years capital gains proceeds be used for buying the house, or only 1 year is allowed, etc. That is also the subsequent questions. Actually, the last just concluded financial year, we have sold shares also.
Okay. So again, just to,
I mean,
I'm just going to broaden the scope of the question so that it's useful for everybody. Basically, I think we want to understand that if you've sold shares in FY24 and there are capital gains that are arising from it, can you offset that to buy a house in the next year or the year after?
No, I think his question is different. I am going to reframe it.
Okay.
What he is saying is that he will sell shares in FY24, he will sell shares in FY25, right? And say buy the property in FY25. Okay. Can he use the capital gains proceeds of 2 years?
Accumulate that, yeah.
And accumulate that and buy one property.
Yeah.
Okay. The answer to that is yes, but like everything else in tax, there is a qualified yes, right?
Okay.
Because subject to certain deadlines, if he has not made that investment within that deadline, then he has to have deposited that money in a capital gain account scheme. If he has done that, then claiming multiple exemptions, as I mentioned, for the same property is not a problem, provided you satisfy the other conditions that go with those exemptions.
So again, coming back to my general question, if in FY24 someone sold shares and there are capital gains, and then this individual wants to then sell more shares in FY25, he can put the proceeds in that capital gains account and accumulate everything and offset against the purchase of a house.
So simple. FY24 finished off in 31st March 24. Let us say he had a capital gains of, he sold shares of 50 lakhs and had capital gains of 20 lakhs.
Right.
Please remember, when he is claiming exemption of shares, the entire sales proceeds have to be invested, not just the capital gain portion.
Okay.
Next year, let us say he sells another 30 lakhs on which exemption is, on which capital gains is 10 lakhs, right? It's 80. And let's say that can happen any time in FY25. But if he buys the property in before July of 24, July 31, 24, which is the last date for filing returns, then nothing he needs to do, he can just do it. But if the property purchase is delayed beyond July 31st, 2024, then the FY24 money he will have to invest in the capital gain account scheme, and then as and when he buys the property, then he will have to withdraw and buy. So the short answer to Mr. Roopchand is it's complicated.
Absolutely. We could go on doing, I think, a whole series of shows on this, but then there you have it. House property and taxation can never be an easy subject. But thank you, Mr. Roongta, very much for simplifying it as much as it's possible on television. Well, with that, we have to, of course, wrap up this edition of Let's Talk Money. Thank you for sending us all of those questions. Keep sending the queries. We'll take them up next week. Thank you for watching.
Let's Talk Money.